inviting me, and thank you all for coming in person and people also watching online. Well, I'm very happy to hear that it's more than finance related computing and analysis, because this is very much what I'm going to present today. Is not just about finance, it's also about climate related, well, in this case, risks. So it's very much multidisciplinary too. Also, one of the contributions of this paper is methodological. So it's a new way, a novel approach to identify common volatility shocks. So the idea is that this can be applied to any other application that you may have attended. Okay, so let's start. So just this disclaimer that the views I'm going to express here today are not necessarily those of associated institutions. So to reduce carbon emissions and to mitigate the effects of climate change, a global energy transition is underway. Okay, so in 2021, more than 80% of primary energy consumed worldwide was still being produced by means of fossil fuels. By fossil fuels, as you might know, they include oil, gas, and coal. Coal is the worst polluter of the three. In the most or largest emitting countries, coal has been declining, and you may even say that it's has already peaked in some of these countries. But oil and gas, they are still increasing close to historical rates. So forward-looking climate policies should thus be focusing on at least these oil and gas, but also coal, because countries like India and China, they still have a large proportion of energy being produced by using coal. So it's clear that these fossil fuels, they are intrinsically high in carbon. So if we want to mitigate the effects of climate change, and we need to reduce carbon emissions, so we need to divest from fossil fuels. And this has been is being reflected in the pledges to reach net zero carbon emissions, or more generally greenhouse gas emissions. And these pledges have been surging in the climate agenda of not only governments, but also large companies and hedge fund firms everywhere. So this clearly is exposing financial markets, investors, firms to climate change, right? So for these reasons, this exposure, financial supervisors, they have recognized climate change as a new source of financial risk. Okay, so today I'm going to focus on carbon transition risk, which I will define in a moment. But if you go, let's say, to the Bank of England, you may find three types of climate-driven risks there: physical risks, transition risks, and even liability or litigation risks. So physical risks are the risks associated with changing climate conditions, and then the drivers are either acute or chronic. So acute related to disasters, natural disasters like floods or hurricanes, and chronic is related to changes in climate patterns, so global warming, so increasing global mean temperature and sea level rise. And then you have the other side, transition risks. So today I'm again going to focus on transition risks, and the drivers are mainly policy changes, market sentiment, and technological change. So in particular, carbon transition risk is the risk associated, so losses or higher costs associated with reducing carbon emissions. Okay, this is important for financial markets because this might prompt the reassessment of the value of a large range of assets, and it might lead to sudden and unanticipated movements in financial asset prices. Now, the speed and the extent of this repricing is, of course, it's uncertain and may have implications for financial stability. So it's obvious that carbon-intensive activities or businesses, they are less resilient to transition risks, right? Their investors, they may experience lower returns, they may have suffer large losses, and their assets may become stranded. Now, there is already evidence, scientific evidence, that investors are already pricing this carbon transition risk, so they are demanding a compensation for their exposure to carbon emission risk. Bolton and Carpentich, they analyze they start with the US based stocks, but then they also have an analysis for countries, for all countries in the world, so a global analysis. They find differences. So brown assets, investors in brown assets, they demand a higher carbon premium compared to green assets. Countries where we see more stringent climate policies, they tend to also, assets in that country tend to also have a higher premium. So there is evidence that markets are already or start pricing this carbon emission risk. Yet, and especially in a disorderly transition, what we may see is that investors and businesses, they may fail to fully anticipate and incorporate the impact of climate policies in their business models. And on top of this, all these drivers of financial instability, these adverse effects on financial markets, they are amplified by the interconnectedness of the financial system, and they are also amplified by raising investor awareness, as we will also see today. Now, to build climate resilience financially, regulators, financial supervisors, they are becoming more and more interested in identifying climate-related shocks to financial markets, and they are looking into integrating climate risk management into business practices and financial decision making. So what we expect today is to fill both gaps, especially on the identification of climate-related shocks, global shocks to financial markets. Oh, this thing, right? Can I'm afraid, how can I move this? If I do like this, aha, okay. Oops. Okay, the motivation for this paper is very much related to the global nature of both the oil and gas industry and the carbon transition. And so we expect prices of especially carbon-intensive assets all to move in response to climate change news or climate concerns or changes in policies or even technological change. So what we propose here is a novel approach. So this is a methodological contribution where we model first climate, well, this is a two-step approach in order to model climate common volatility, okay? And so to identify climate-related shocks, to measure their impact on financial asset prices. So the two-step is, in the first stage, we are going to measure, to measure the magnitude of global common volatility shocks to a wide range of oil and gas stock prices. And then, in order to identify climate-related shocks, or in order to find a systematic association between climate shocks and these movements in oil and gas share prices, we project this common volatility measure onto volatility shocks that we will construct using text-based climate change news indices. So using closing prices of oil and gas share prices, shares from all over the world, we will show empirically that climate change news does make oil and gas share prices from all over the world to move at the global scale, and to move at the same time. And we will also show that not all these climate-related global shocks are alike. So they not all have the same impact on the oil and gas industry. So let me introduce you to the global COVOL model that I'm going to present here for the specific data set on oil and gas. So this model was developed, I forgot to mention before, sorry, this is important. So this is a joint paper with David Andre from Oxford, Nuffield College at Oxford University. And the model I've developed before, so this global COVOL model was developed by Rob Engel and myself, and we decided to, David and I, to apply this model to climate-related global shocks. So I'll first introduce you the model, and then I'll focus more on this application in particular. So globalization, digitization, they have made, given these, news can spread almost instantaneously, right? Certain events, certain shocks can have a global impact and almost immediately make all financial markets move at the same time and unexpectedly and at the same time. So what we are going to start, we start with a vector of oil and gas stock returns. Okay, so we assume that these returns, as usually in the financial literature, we will assume that these returns are determined by a certain group or set of factors. Okay, so these are will be included in this vector F. In this case, because again we are focusing on the oil and gas, these factors include the FAM and French, 3 factors, and to control for oil price shocks, we also include the WTI crude oil 1 month future. Now, if this model 1 is correctly specified, and these factors are sufficient to reduce the contemporaneous correlation of the residuals to 0, then this means that what we have in this vector H is, we will have here the idiosyncratic conditional variances, and in E, we will have the idiosyncrasies. Now, it's not surprising that these idiosyncrasies will be orthogonal, okay? What is surprising is that no matter what factors we extract out of this data, we will see that these volatilities, these variances, they are still correlated, they still commove. Okay, so this is the observable and most interesting implication of the global COVOL model. So what we assume again is that these standardized residuals, they have to be orthogonal, or they should be, like I should say that put this way. So they should be orthogonal in both time series and cross section with unit variance. But this does not mean that they will be independent. In fact, what we see is that these square these, so their squares will be correlated in the time series. Okay, I don't know if you are familiar with the Garch literature, but the original motivation of the Arch model by Engel in 1982 was precisely that the residuals, they may not be independent, meaning their squares are correlated in the time series. And what we see here, or the motivation for the global COVOL model, is that the standardized residuals again are orthogonal. Okay, and recall that these are volatility standardized residuals. They are orthogonal in both time series and cross section, but they are not independent, meaning their squares are correlated in the cross section. Okay, so we are going to extract or to use the information from this cross-sectional information in the global COVOL model. So for you to understand better what's going on here, let me define a volatility shock. So a volatility shock is going to be represented by this Greek letter phi, and I'm using sigma here to remind us that we are dealing with volatilities, okay, which is different from say factor models or other models for the mean. We are dealing with the volatility, okay, in this case. So this is a shock to volatility. So it's going to be defined as the proportional difference between the squared idiosyncrasy and its expectation. So the way of interpreting this is on certain days, the squared E is going to be bigger than 1, bigger than usual. On other days, this squared E is going to be lower than usual. So if on a specific day you have many squared E's, or the squared E's of many assets bigger than usual at the same time, this is then a common volatility shock. Okay, so it's a shock, volatility shock, that is common to all the assets, asset prices that you have in your sample. Okay, so this is a way of, again, measuring the magnitude of this, or in capturing, identifying shocks that are common to a large range of assets. Now we need some parametric assumptions, okay, in the form of this relation. So I'll start by introducing some notation. So F is going to be, again, sigma, to denote that we are dealing with a volatility factor. So this is going to be our oil and gas common volatility factor. This is a latent factor that is going to measure the magnitude of a volatility shock common to all oil and gas stocks in our sample. We need further assumptions here to guarantee what we saw previously. So to guarantee that the standardized residuals remain orthogonal with unit variance. Then S is going to be the factor loading. So this factor loading is bounded between 0 and 1, and is going to be interpreted as, so it represents the fraction of the oil and gas co-vol factor that impacts the volatility of a specific asset, a specific oil and gas stock. Now, because variances and covariances of the squared E's are different across assets, this is likely to reflect the fact that these S's, these factor loadings, are different across assets. And I'll explain it a little bit later, but the important implication of having different loadings across assets is that it allows us to hedge against these global risks, because some oil and gas firms may be more exposed to climate risks than others, because their prices move even more to climate-related shocks than others. So you can hedge, even though they all move, some move more than others. So you can hedge against these risks. Okay, so we can specify a function G. Okay, let's look here. A function G as the data generating process of the random variables E from the factor loading, the latent common volatility factor, and the standard normal random variable epsilon here. So by assuming this particular specification, okay, and you could use other specification if you wanted. We assume this one, it works well, it satisfies the conditions of the model. In any case, the idea is that this factor here is going to capture all the common variation in these random variables E, okay? So when F is high, it means that all E's are likely to be bigger than usual, and when F is low, it means that all E's are likely to be smaller than usual, right? So F is going to measure, again, the magnitude of shocks that make all these volatilities to move at the same time, okay? All clear so far? I hope so. Okay. Of course, yes, please. Yes, so again, it has to be bounded between 0 and 1 in order to guarantee, again, that these are orthogonal with unit variance. Because the way we specify the model, it has to be between 0 and 1. But second, it's also convenient, because then it's easier to interpret this factor loading, because it's going to represent the fraction, again, of the latent factor that impacts a specific asset. So if S is 0.5, it means that it's going to impact, it's 50%, let's say, of the value of F is going to have a positive impact on the volatility of asset I. Okay, so the log likelihood function, oh no, sorry, where are we? Yes, oh, testing first, okay. So to test for oil and gas COVOL, we don't want to estimate a model if there is no common volatility, right? So to test for the presence of global COVOL, or in this particular case, oil and gas COVOL, we can simply use the empirical variance-covariance matrix for the squared E's. Remember that if the squared E's are uncorrelated, it means that the E's, the standardized residuals, are independent, and so no movements of any kind can be observed, right? So what we need to find is whether these squared E's, where residuals are or are not correlated. So again, for that, we use the variance-covariance matrix under the alternative. So under the null, first, it means that this variance-covariance matrix for the squared E's is diagonal. So no correlations, right, between the squared E's. Under the alternative, we assume that all assets have the same loading on the factor, and the loading is equal to 1, which makes everything a lot simpler, because under the alternative, then this matrix is going to be equicorrelated, meaning that when a shock hits this industry, all pairs of assets are going to be impacted in the same way, meaning they all have the same correlation. And so we can simply reduce our test problem, or our hypothesis in this case, to this here, meaning that what we are going to test is whether the average or the equicorrelation of the square residuals is equal to 1 against the alternative that this is actually positive. So if the square residuals are, let's say, on average, positively correlated, it means that there are certain shocks that make all these assets move, asset prices move at the same time. This is the test statistic, which follows a standard normal under the null hypothesis. The test has good size and power for using Monte Carlo simulations. This is very high level, a very short overview. This is not the contribution of this paper, but I think it's important to explain the test, because we are going to apply it later. And now finally, to estimate this model. So the log likelihood for this model is not the classical one, in the sense that these F's, they are not observed, right? We are going to estimate them. So what is a common approach to overcome this is to just compute the log likelihood as these were observed. Okay, these are not parameters. This is a random variable, but we will assume as these F's were observed, and this is called data augmentation. And assuming normality of the errors, we just compute the log likelihood as usual. Okay. Then we derive the first order conditions with respect to both the loadings and the global factor. And these two conditions will give us two heteroscedasticity relationships. So using a cross section, we will be able to estimate the value of the factor for each point in time t, conditional on the estimated loadings. And then using a time series regression, we will estimate the factor loading for each asset, conditional on the estimated values of the factor. So to gain efficiency, what we then do is to iterate these two regressions until convergence. Okay, so at that point, both first order conditions are satisfied, and a global maximum, or sorry, a joint maximum, maybe I should say, put it this way, a joint maximum can be achieved. Okay, of course, we will recall that we are estimating each of these, let's say, parameters conditional on the estimated parameters from the previous iteration, meaning that we will need to come up with certain initial values for the first iteration. And I'll let you know later on what we do.
Quick question, is it very sensitive to these initial guesses?
Actually, it's not sensitive. We use the loadings on the first principal component, but if you just assume 0.5 for each parameter, like really random choice, it converges to the exactly same point. So it's just, it makes sense. If you don't know which parameters, which initial values to use, it makes sense. It's a natural, solution to use the loadings on the first principal component. But I'm confident to say that you can use. It's just the time it will take to reach to the maximum if you choose a very far, very values that are too far from too true for the optimal parameter. Okay, so the data set. We use the closing daily prices of major oil and gas stocks from all over the world. We have the countries that we cover in this sample. You will see that many of them are based in the US. We also include both state and private-owned oil companies, or mixture of both. These are all traded on the New York Stock Exchange because we want to avoid any synchronous observations, and the sample goes from 1983 until recently, January 2021. So keep in mind that the oil shocks of the 70s are not covered in this sample. Okay, so how do we model first oil and gas COVOL? So we need to estimate a factor model for each of the oil and gas share prices. We find time dependence in both first and second moments. So we also include autoregressive terms in the mean models, and we assume Garch-11 errors. Having estimated these models, we compute the volatility standardized residuals and we square them. And then we test whether there is or there isn't evidence of oil and gas COVOL. So just as a reference, I have here the average empirical correlation for the estimated standardized residuals. This is close to 0.1, and the test statistic clearly rejects the hypothesis that this is 0. So this is not 0, meaning that there is positive correlation in the squared standardized residuals, and so we should estimate a global COVOL model to be able to extract these shocks. In the iterative estimation, so remember the time series and cross-section regressions. We need, again, some initial values. We are using the loadings on the first principal component for the squared E's. Then we iterate these two regressions until convergence. And in order to identify the variance covariance matrix, we also need to impose these normalizations here. And finally, so what are the events or the shocks that shake the oil and gas industry? So what we have here is the monthly calendar, monthly averages of the oil and gas COVOL factor, where we have the main events, let's say, labeled. As you can see, there are all sorts of events, right? We find that we can group these events into whether these are likely to drive changes in oil demand or whether they are likely to drive changes in oil supply. Okay. Regarding the oil demand type of shocks, we have stock price stock market crashes. We have the global financial crisis. We have the COVID-19 pandemic recently. We have presidential elections that you may argue, well, they may also affect oil supply. From the oil supply side, I think it's more clear when we think about OPEC meetings and announcements, as these are likely to drive changes in the oil supply, but also in the prices of oil and gas companies. So just a few examples of these oil supply kind of shocks. So here we have on November 28th to 2014, when Saudi Arabia blocked the OPEC announced output cut, and this made oil prices to crash, and the shares of oil and gas companies around the world to follow suit. So another day where we find, oops, sorry. How can I remove that? Okay. So another event, oh my God, sorry. Another event, one of the largest events shaking the oil and gas industry is when in September 16, 2019, recently when there was this drone attack to the Saudi Aramco facilities, causing its biggest disruption ever. So bear in mind, remember that this shock impacted not only oil supply, but also the share price of oil and gas companies, not just this one, all over the world, okay? All these oil and gas share prices that we have in our sample moved in response to this shock. Now, you may ask, okay, but this talk was about climate-related shocks. So how, within this multitude of shocks, these so different shocks, how can we find a systematic relationship, between climate-related shocks and movements or movements in the oil and gas industry? You could say, well, when Trump was elected, this could be seen as a positive news in terms of climate risks, because, well, then they decided to withdraw from the Paris Agreement. So in terms of transition risk, this could be seen as a positive news. And then when Biden was elected, then US rejoined the Paris Agreement, you could say, well, that's probably a bad news or negative news for the oil and gas industry. But this is not enough, right? We need a systematic way of finding a relationship, an association between climate shocks and movements in the oil and gas industry. Just another example of another climate-related shock that we find shaking all these asset prices. This was after the Deepwater Horizon disaster, right? The oil spill. And what we see here is that the spill finally sank in with investors. So it made a week later that after the disaster happened, all these oil and gas prices started to move, and it was associated with the oil spill that had happened a week earlier. So we find some, visually we can find some climate-related shocks, but what we now will do is to have a method to systematically find an association between them. Just as a measure of goodness of fit, is this global COVOL model good to capture these movements in the data set? Well, what we do is to rerun the test, but now on the standardized residual, standardized by not only the volatilities, but also the global COVOL factor. And what we see is that now we don't find evidence that these standardized residuals are correlated, meaning that the oil and gas COVOL factor can clearly capture these movements, and now we find no more evidence for the presence of common volatility. Okay, so let me introduce you the measures that we are going to use. We don't develop text-based proxies for climate news or shocks, okay? We just use off-the-shelf measures, and they work pretty well. I know that some of you are developing new text-based measures, so maybe we can then use them also here and see what happens. So one of the limitations of the measures I'm going to show you is that they are updated only until 2018. I don't know, they probably already updated until more recently, but I don't think they do this on a daily basis or something. So that could be something, an improvement. Okay, so the Media Climate Change Concerns Index developed by Ardia and co-authors. This is an index, text-based, of course, index that measures unexpected increases in climate change concerns. So they construct this measure by applying text mining to measure US-based newspapers. So the index reflects both the percentage of risk words, okay, and the degree of negativity of the climate change news, right? So you can say that it's a sort of mix between first and second order shocks, given that it's related to the sign of the shock or the news and the risk, so also the magnitude of the shock. Another interesting thing about this index is that it's available for different themes and different topics, which allows us to compare climate-related shocks. And as we will see, they are not all the same, definitely. And they have a different impact on financial markets. So here we have a plot of the MCCC index over time. Two takeaways. The first, climate change concerns is increasing, especially in the most recent period. We see an increasing trend here. And also, climate change concerns tend to increase or to peak around UN climate summits, as you can see here, COP15, I believe, and in 2009, and then here during COP21 when the Paris Agreement was sealed. Now, in order to distinguish positive from negative climate change news, we are also going to use the Climate Change News Index developed by Rob Engel and Chris Waters at NYU and Yale. So they provide two different indices. We call it the generic one. Both are constructed by applying text mining. The generic one is based on the Wall Street Journal, and the negative one uses also the Wall Street Journal, but also other sources. So the difference between these two is that in the negative, they also measure the degree of negativity of the news. So the negative index is going to reflect is the share of all news articles related to climate change, but that have been assigned to the negative sentiment category, okay? So these are purely negative news. And now you may argue, oh, but you know, when it comes to climate change, no news is positive news. Well, we don't want to spuriously capture news related to, let's say, carbon capture and storage as an increase in climate risk, right? So that's why it's important to have this distinction and have only, say, pure negative climate change related news. So this index is available from 2008 and 2018, so only 10 years of more or less of monthly observations. I don't know if I mentioned this, but this one is a daily index. Okay, so we can find evidence for climate-driven volatility shocks at the daily frequency. You mean this? We are here, right? So in this case, as far as I understand, you have a newspaper, and then you have to select the ones that are climate change related. Then you have a set of words related to risk. So you have to identify this vocabulary related to. Yes, they use lexicon, the software, right? Yes. So that's what they do. And then in order to find news, so, you know, these unexpected increases, they just use an autoregressive model. And there are other things that, well, I wasn't going to mention, but it's important. So they give higher weights for negative news compared to positive news. They give also higher weight for time series changes rather than changes or variability across newspapers. So there are, it's not that straightforward. agree with you. What I can say is that we use two different indices with two different methods or methodologies to measure this sentiment, and they both give us the same answer. So at least it's robust to different methods to capture this negativity of the news, as we will see later. So of course we cannot simply, if we want to capture positive news, let's say, we cannot simply subtract one from the other because they are based on different methods and different sources. But we plot both here so we can compare. And again, at least two takeaways. They tend to move together, positive and the generic, I should say, it's not the positive, it's the generic, including positive and negative news. They tend to move together. They tend to peak at the same time, and again, around UN climate summits or other kind of climate change summits. And an interesting thing is this peak here that shows up in the generic index, but not in the negative index. I don't know if you know about the ClimateGate email controversy of the Climate Research Unit at the University of East Anglia. So basically some emails were leaked, and climate deniers use these emails to spread, fake news that scientists are making up climate change does not exist, all this. So in terms of transition risk, this is hardly negative news, right? If people believe that climate change does not exist, then there's no need for a transition. So that's why and I think that's why this methodology is robust, because you find, so this is highly covered by the Wall Street Journal, this ClimateGate email controversy, but it doesn't show up in the negative climate change news index, right? So I think we can see this as a robustness check, let's say, of the negative index, that it's capturing only negative news related to climate change. Don't know how much time, like 15 minutes, more or less. No, it's fine. This is just the results, so 10 minutes, I think it's really good. Okay, so in order, again, just to remind you the methodology here. So we have the oil and gas common volatility shocks, and now we are going to project all these common shocks onto volatility shocks constructed from these text-based indices. Okay, so we want to see whether there is this systematic association between the two. So as a dependent variable, we will use the centered oil and gas common volatility factor, and as explanatory variables, we are going to use volatility shocks to all these news indices, and to control for other shocks affecting the oil and gas industry, we will also use these covariates here. So shocks to oil price shocks, shocks to the US stock market, and shocks to the world stock market, okay? Yes, we will use both at the same time precisely to disentangle positive from negative. By including both, the negative will capture only the negative, and then the other one will capture, let's say, the remaining effect. And you will see, given the results, I think it's, given the way we do it, then the results, I think it makes sense to include both. So the results for when we use the media climate change concerns index, again, this is a daily regression analysis. So the first column we have the most simple regression. Okay, so we have oil and gas global regressed onto this media climate change concerns index shocks. And what we see is that this is statistically significant. This is positive, meaning that climate change related shocks, they do make all these oil and gas stock prices from all over the world to move at the same time. So they create turmoil in the oil and gas industry. Again, you may say, well, there are other shocks that might affect the oil and gas industry. So that's why we also include these control variables here. What we see is that they all drive also shocks in the oil and gas industry. So oil, as I showed you, a shock to the oil price is likely to spill over to the companies that produce the oil. So as we see here, if there's turmoil in the oil market, as oil as a commodity, this spills over to the oil and gas industry itself. Now, there are certain shocks that are specific to the energy sector, and given that in our sample we have many firms from the US, we also use the Spider Energy Selector, Energy, how is it called? Energy Select Sector Fund. So we replace the US shocks to the US stock market by shocks specific to the energy sector. And again, not only, of course, we find a positive impact, we also see that still we find, so it's robust, our finding that some of this oil and gas common volatility is driven by rising climate change concerns. And then we interact these volatility shocks to the climate change use indices with the control variables. But one interesting finding is probably this one here. So what we see here is that shocks to the energy sector are likely to be amplified by negative news about climate change. Okay, so let's think of it could be the deep water disaster, horizon disaster, right? So it's likely to impact the energy sector. So it's going to be a shock to the energy sector. And at the same time, it will raise concerns about climate change. So the environmental impact of oil and gas firms, right? So this is likely to be a climate-driven shock, which will be reflected in this variable here. And what we see is that this is going to amplify the shock that we have already seen to the energy sector.
So those multiplications for the interaction.
Yes, just multiply one variable by the other, and of course we include both separately also in the model.
And the two stars, what level does there apply?
Oh, interesting. I don't have it here. So 3 stars should be 1%, 2 stars should be 5%.
I'm sure that cannot be the other way around. Like, we're not employing it less than at once.
Sorry, I'm not sure if I'm following.
Like, there is a shock.
Mm-hmm. Oh, okay, I see what you mean. And that is going to raise concerns about climate change. Yes, but that is going to be like a feedback in impact, right? So that comes back to the oil and gas industry amplifying the effect. Yes, exactly. So it's hard to disentangle, right? To say which one is causing which. The thing is, they both amplify the effect and they create even more turmoil in the oil and gas.
One more question, please. So looking at the answer where the value of the cumulative component to take forward the that's leaving a lot of the variance.
You know why? Because these are daily observations. And no, wait. And why am I mentioning these daily observations? Because we don't expect common shocks to happen every day, right? So many of these days, the volatility factor will be 0. So it's not easy to explain 0 values, right? If they don't change, how can you explain what could be the explanatory variables, right? So that's why you will find a relatively small R-square for the daily tables, but you will see that these will improve when we use monthly observations, because then these zeros are, smooth. But then at the same time, you mean just taking into account the ones that are not 0?
Yeah.
It could. I don't know. I feel a bit reluctant about, deleting information. If it was 0 on that specific day, but imagine that there was, a very climate impactful event. So how can then I explain that my model is robust to, these I think the best way of overcoming this is to use the monthly index, and then you will see the results are even better. Okay, as I told you, we can have these climate concerns indexed by different themes. Here we have the themes in order from the most covered or discussed to the least discussed topic. The main takeaway from this table is that oil and gas turmoil increases in response to climate change news related to financial and regulation, to societal impact and agricultural impact. These are pretty much obvious, and I'll talk a bit more about this in the next slide. What is surprising, maybe, is disaster. Actually, it has a negative impact on oil and gas overall, meaning that it seems to reduce oil and gas common volatility. And it's not that surprising if you go into the literature, because it's evidence on whether financial markets are pricing physical risks is mixed. Okay, so what we see here is that the news on a particular disaster is probably going to have only a local impact where the disaster happened, and so unlikely to have global effect unless these disasters they become too frequent and widespread, again raising concerns about the transition, and then you could see a positive impact here. Okay, I need to jump. Now for the topics. These are really interesting, I think, because then you can really see what are the drivers of these oil and gas movements. So let me just focus on topic 31 and 40. So these are related to financial and regulation, and these topics you can see they are explicit mentions of oil, fuel, carbon price. And topic 40 is related to technological change. So we can clearly see evidence of technological change driving, movements in these oil and gas, on these carbon intensive companies. Then we also have topic 20. I find it very interesting. So as you can see, it's food, animal, meat, cow, cattle. So it's related to livestock. And what we see here is that, after all the pressure that is still going on oil and gas companies, we also see a lot of pressure on agribusinesses, right? So due to their climate damaging agricultural practices, what we see here is that this pressure on these businesses is also overlapping, or is also spilling over to the oil and gas industry. And why is that? Because livestock is emitting a lot of methane, right? So it's likely that in order to reduce greenhouse gas emissions in general, including methane, it's also likely that we want to reduce other emissions, including CO2 emissions, and those are the ones related to the oil and gas. And finally, a topic that you don't see here, but you might ask about, climate litigation. It's not here because it's not significant. We didn't find any evidence. And again, if you look into the literature, and more specifically what LSE has been working on, the Grantham Institute, climate litigation cases, they have most been filed before court, and they are mostly brought against governments. Okay, only a small number, yet increasing, of cases is targeted at companies. So it's not surprising that it's not yet reflected here. And finally, the last table, the monthly climate change news index. So we want to distinguish positive from negative news. As you can see, by including both, we see that positive news, or the generic news, is capturing the positive news, and this has a negative impact on oil and gas common volatility, and negative news does increase turmoil in the oil and gas industry. Also note the R-square, which is a lot higher in this case. In the second column, we have interaction terms again. What we see here is that oil price shocks, they are amplified by negative news about climate change. But negative news about climate change seems to be attenuated by global stock market shocks. Okay, so the way we interpret this is that financial markets, they are still seeing stock market shocks as more relevant or more important than climate change related shocks. And in the last column, something that we do differently here. So instead of using the oil and gas common volatility as our explained variable, now we are using the US energy sector. So we have volatility shocks, okay, to the specific to the energy sector. And let's see if we find an association with climate change news. And surprisingly or not, we don't. Okay, so if we just focus, instead of using all these oil and gas stocks, we just focus on the US energy sector. So use the index, right? And let's see if we find evidence. We don't. If we use any of the oil and gas stocks separately and we do the same analysis, again, we don't find evidence. If we just use the oil price, so the WTI future, we also don't find any evidence between, you know, any association between the two. And why is this the case? And I think this is probably the most interesting contribution of the paper is that this is truly global. News about the transition is really global, and the transition is really global. So you need a global model, such as global COVOL model, to capture this information about global shocks. So you need to capture the cross-country information in order to find an association between these global transition shocks with movements in the oil and gas industry. And also, because we use the crude oil price and we don't find evidence, it seems that investors, they are pricing the companies and not the oil as well as a commodity. Well, thank you very much. I hope with this work we can shed some light on the national and international exposure of to climate-related shocks. We also hope that firms and governments, they will rethink the way they publicize or politicize the climate pledges. A firm that announces an unfeasible climate target, or a government that fixes a carbon price that is too low or ineffective, it's not only damage the firm or country's competitiveness, but also disrupt financial markets. And that's what we are trying to show here. Well, thank you very much.